It is Friday, May 1st, 2026. John and Mary Henderson are sitting in a glass-walled conference room at First American Title in Sarasota County, Florida, staring at a wire transfer receipt for $846,000. Mary is crying. John is grinning like a man who just won the lottery. The realtor is pouring complimentary champagne. Everyone is calling them smart. Everyone is calling this the responsible decision. The 5-bedroom colonial they bought in 1986 for $80,000. The one where they raised 3 children, where the dog is buried under the dogwood tree, where Mary remodeled the kitchen with her own 2 hands in 2009, just sold for $900,000. They are debt-free, liquid, downsizing into a 2-bedroom condo on the Gulf Coast for $350,000 cash. They believe they just executed the smartest financial move of their entire retirement. They are catastrophically, mathematically wrong. By April 15, 2027, they will owe somewhere around $72,000 in federal capital gains taxation. By January 1, 2028, their Medicare premiums will more than triple, because of a stealth surcharge most retirees have never heard of. When the dust settles, this so-called brilliant downsizing decision will have cost the Henderson family approximately $154,000 in confiscation, surcharges, commissions, and stealth penalties. They are still drinking the champagne. Downsizing your fully paid-off family home in 2026 is, for the vast majority of middle-class American retirees, the single most expensive mistake you can possibly make. It is worse than buying a timeshare. It is worse than co-signing your grandchild's car loan. Every other financial mistake comes with a warning label. Downsizing comes wrapped in praise. Your kids encourage it. Your friends celebrate it. The financial press writes glowing articles about right-sizing for retirement. The real estate industry, which collects an average of $54,000 in commission on a $900,000 sale, has spent 20 years marinating the American senior in the propaganda that selling the family home is the responsible, mature thing to do in your golden years. It is a lie. A beautiful, champagne-pouring lie. Engineered by a tax code written in 1997 that has not been meaningfully updated for inflation in 29 years. This is a survival guide for a rigged housing market. Consult a CPA. But most CPAs are tax preparers, not tax strategists. They will fill out your Form 1040 with the precision of a Swiss watch and never once warn you about the IRMAA cliff that is about to flatten your healthcare budget. In 1986, they bought their home for $80,000. That is the cost basis, the original purchase price plus qualified capital improvements. They sell in 2026 for $900,000. After subtracting $54,000 in commissions and $15,000 in closing costs, their amount realized is approximately $831,000. Their gain? $831,000 minus $80,000 equals $751,000. Section 121 of the Internal Revenue Code allows a married couple filing jointly to exclude up to $500,000 of gain on the sale of their primary home. The Hendersons qualify. They subtract $500,000. They are left with $251,000 of taxable capital gain. That $500,000 exclusion was set in 1997, 29 years ago. In 1997, the median American home cost about $125,000. The exclusion was 4 times the median home price. It was designed to be essentially impossible to exceed unless you were actually wealthy. Today, the median American home is approximately $420,000. In coastal California, southern Florida, suburban Boston, Austin, Nashville, and roughly 40 other metro zones, it is well over $700,000. The $500,000 exclusion is now barely larger than the median home price itself. And it is not indexed to inflation. Every other meaningful number in the tax code gets adjusted upward for inflation. The Section 121 exemption sits frozen, calcified exactly where it was in 1997. while every retiree's home value tripled around it. This is not an accident. This is a feature. It is a stealth tax increase that requires 0 votes in Congress and 0 political accountability. The Hendersons have $251,000 of taxable long-term capital gain. With John's pension of $40,000 and combined Social Security of $50,000, their baseline taxable income is around $80,000. Stack $251,000 of gains on top, and their total income balloons to $331,000. At 15% long-term capital gains rate, $37,650 in federal tax. Then, the net investment income tax. 3.8% on net investment income for couples with MAGI above $250,000. Adds another $3,078. State tax. Florida charges 0. Ohio adds about $8,785. California treats capital gains as ordinary income, adding $25,100. Same transaction, same retirees, same profit. Ranges from $0 in Florida to over $25,000 in California, depending on a single line on a map. In tax-friendly Florida, the Hendersons owe $41,000 before the state even shows up. Ohio, $50,000. California, $66,000. The second villain is so much worse that it is borderline criminal that the realtor and the escrow officer let the Hendersons sign the closing papers without explaining it. The second villain is IRMAA, Income-Related Monthly Adjustment Amount. It is a stealth Medicare surcharge the federal government applies to your Medicare Part B and Part D premiums, based on your modified adjusted gross income from 2 years prior. The Social Security Administration does not look at your current income. They look back at your tax return from 2 years ago. There is no warning. There is no notice at the closing table. The realtor is not legally required to disclose it. Your CPA might mention it in passing, but by then, the wire has cleared and the damage is locked in. When John and Mary sold their house on May 1st, 2026, the gain will spike their MAGI to approximately $330,000. 2 years later, on January 1st, 2028, the SSA will pull that return and assign them a brutally inflated Medicare premium for the entire calendar year 2028. In 2026, the standard Medicare Part B premium is approximately $185 per month per person, $370 together, about $4,440 a year. Manageable, built into their budget. But their 2028 IRMAA tier adds $385 per month per person on Part B, plus $75 per person on Part D. That is an additional $920 per month, every single month for the entire year of 2028. $11,040 in extra Medicare premiums for 2028 alone. And the surcharge can ripple into 2029, doubling the damage. Selling your home does not just trigger one tax bill, it triggers a chain reaction. The capital gains tax feeds the NIIT, which inflates the MAGI, which spikes IRMAA 2 years later, which raises Medicare premiums, which compresses the retirement budget, which forces larger IRA withdrawals, which can trigger a new IRMAA cliff in 2029. A cascading, multi-year, compounding wave of confiscation, all from one signature at one closing table on one ordinary spring afternoon. By the time the Medicare premium increase shows up in 2028, John and Mary have completely forgotten the cause was the house sale in 2026. They blame Medicare. They blame inflation. They never blame the realtor, because nobody told them the realtor was the trigger. Total wreckage in Florida: $54,000 commissions, plus $15,000 closing costs, plus $38,000 federal capital gains, plus $3,000 NIIT, plus $22,000 IRMAA surcharges, equals approximately $132,000. Ohio, north of $140,000. California, pushing $160,000. The realtor pocketed $54,000. The IRS pocketed $41,000. Medicare pocketed $22,000. The Hendersons walked away with considerably less than they thought. Strategy 1 is the step-up in basis under IRC Section 1014. When an asset is inherited at death, the cost basis is automatically reset to its fair market value on the date of death. If John and Mary hold the house and pass away in 20 years when it is worth $1.3 million, their children inherit it with a $1.3 million cost basis. They can sell it the next day and pay zero in capital gains tax. 40 years of compounded gain, federally erased in a single moment of inheritance. The capital gains tax is not just deferred, it is eliminated permanently. Strategy 2. Track every capital improvement and add it to your cost basis. Roof replacements, new HVAC, kitchen remodels, bathroom renovations, decks, pools, solar panels, window replacements. All of it adds to your basis. The Hendersons almost certainly invested $120,000 to $180,000 in improvements over 40 years. If they had kept the receipts, their basis would be closer to $240,000, shrinking the taxable gain from $251,000 to $91,000 and cutting the tax bill by nearly $25,000. Start the folder today. The IRS is counting on the fact that you do not have one. Strategy 3. The reverse mortgage. Formerly the home equity conversion mortgage, regulated by HUD and FHA. A reverse mortgage lets you draw against your home equity while continuing to live in it. Because you are not selling, there is no capital gain, no NIIT, no IRMAA spike, no 5% commission. For a retiree sitting on $700,000 of trapped equity who needs liquidity and wants to preserve the step-up at death, it is a vastly superior tool to a downsizing sale. Strategy 4. If you absolutely must sell, time it strategically. Sell in late December and the gain hits one tax year. Sell in early January and it hits the next. Using an installment sale under Section 453, you can spread the gain across 2 years and dramatically flatten the IRMAA cliff. Strategy 5. Seriously evaluate whether you need to downsize at all. Hire a cleaning service. Pay a lawn care company. Convert a downstairs room into a primary bedroom. Install grab bars. Get a stair lift. The total annual cost of those accommodations is almost always less than the one-time tax hit of selling. Before you sign a listing agreement, sit down with a pencil and a calculator. What did you pay? What capital improvements have you made? What is your real cost basis? Subtract the Section 121 exemption. Calculate federal capital gains, NIIT, and state tax. Project your MAGI. Look up the IRMAA brackets. Project your Medicare premium increase 2 years out. If the total damage is more than 20% of sale proceeds, you are walking into the slaughterhouse and need to reconsider. The cultural pressure to downsize is overwhelming. Your kids think you should. Your friends think you should. HGTV makes entire shows about it. But when you include every cost, the Section 121 cliff, the NIIT, the IRMAA lookback, the commissions, the closing costs, the HOA fees, and the loss of the step-up at death, the math almost universally favors aging in place. The system is mathematically, structurally, by design optimized to extract $150,000 from the Henderson family every time a fully paid-off family home changes hands in Middle America. The realtor is not your financial advisor. The escrow officer does not know what IRMAA is. The Medicare premium notice will arrive in October 2027, and by then, the wire has cleared, the signatures are notarized, and the IRMAA is queued up. The only question that actually matters in retirement planning is this: is the smaller house worth $150,000 to you? For most of you, the answer is no. Do not be the Hendersons. Do not pour the champagne. Do not sign the papers until you have run the numbers.